Welcome to this Killick Explains video, and this week I want to get into the mindset of a successful investor. Now, you might say that's quite a difficult trick to pull off, but actually with a degree of experience, I think we can analyse what makes a successful investor and which psychological biases, if you like, you need to balance in order to be one. So, first of all, 2022, you hardly need me to say again, has pretty much turned the last 2 decades for investors upside down. And that's why it's a good time to think about what kind of mindset might be helpful in what is a brand new environment for an awful lot of younger investors. So just to summarise, inflation and interest rates are on the rise. As I make this video in mid-November 2022, there's some evidence that interest rates may not have to rise quite as fast as people thought, but nonetheless, they're still going up, if you like. Risk assets have been hit pretty hard. Technology stocks, cryptocurrencies, the high-risk end of the bond market have all taken a bit of a hammering. China has been struggling for a while and is still struggling to shake off the ramifications of COVID, lockdowns, and get that sort of manufacturing engine back on track. And the world, partly as a consequence, is starting to fragment and deglobalize. Russia's war in Ukraine hasn't exactly helped. Companies are busy reshoring where previously they looked outwards, if you like, to try and establish global networks. All those things are changes that have happened relatively recently, and they change the investing world, and not in a good way for an awful lot of investors. Okay? However, that all being said, all that bad news, long-term, stock markets tend to deliver. All right? So investors, in my mind, need to basically balance 3 different competing traits, mental traits, if you like, and it's balancing those which is the key to long-term success, not letting any one of them overtake you, particularly in the short term. So what are they? First of all, optimism. All right. Now, optimism is really important if you're going to invest successfully. You have to believe that humans are capable of evolving, are capable of solving problems, even huge ones, all right, and have the necessary energy and creativity required to do so. All right. So basically, investing is all about accepting that humans evolve, they've got the capacity to solve problems, okay, and investing is the route to tapping into creativity and progress. You're buying into entrepreneurship. You're buying into the individuals and the companies that long term can hopefully keep increasing the rate at which the global economy grows and offers investing opportunities. But optimism alone, I think, can be a little dangerous. Optimism alone is what leads people to make mistakes in everything from cryptocurrencies to Robinhood, single stock investing, and so on. So you need some realism too. And realism I break down into sort of 3 components, if you like. The realistic mindset says get rich quick is a myth, so I'm not going to even try to do that. Investing should be simple, but it isn't easy. All right, it's recognizing that whilst there are golden rules, if you like, that all investors should follow, it isn't straightforward, as Warren Buffett once put it. So although you should keep your strategy clear, simple, understandable, ultimately, all right, you do have to wait and work at long-term returns. And thirdly, volatility is the price you pay for those long-term returns. So a realist won't panic when the market drops. Equally, they won't go bananas when it suddenly rises. In volatile times, it can do either. And we've had swings recently of 3, 4, 5%, sometimes on a daily basis. But realism is all about tempering optimism, albeit that underlying optimism is what is essential to taking the risk of investing in equities over the short term. And then there's pessimism, all right? Now, pessimists have their place in the investing world. Things can and do go wrong sometimes. There are no free lunches. Well, there's one, the long-term power of compounding and compound growth. That, I accept, is a sort of free lunch, but there aren't many free lunches out there. And human error is always a risk. And there are all kinds of ways in which that manifests. Very simple one is the herd mentality. People piling in to get rich quick schemes like cryptocurrency, and piling out again when things go wrong. Okay, so basically human error is always under the surface somewhere. And the trick, therefore, is to thrive in a difficult market. Investors need basically to do three things that reflect optimism, realism, and pessimism, if you like. Number one, stay alert to opportunities. But number two, be realistic about future returns. And number three, be ready for rainy days. And in other videos, I talk about those three things in a lot more detail. Now, if you'd like to watch more videos on these topics or any of the terms I mentioned as we've been along in this one, it's killick.com/learn. If you'd like an investing guide to how to invest in equities, which starts with most of the basics and builds up, then it's not one of these two sitting here, but there is a blue one, and that would be editor@killick.com. And equally, if you want to read about the sort of mindset required for long-term equity investing, for example, in a bit more depth, then Confidant, our flagship quarterly magazine, is not a bad place to go sometimes. There are some decent chunky equity pages in there, and that would also be editor@killick.com.